Cash flow. Definition: the quantum of cash or cash equivalent which the company gets or gives out by the way of payments to the creditors is known as cash flow. Cash flow determination is usually used to analyze the liquidity position of the company. It gives a narrative of the amount of cash flow into the business, from where the amount of cash which flows out. As examined, cash flows can either be both positive or negative. It is calculated by subtracting the cash balance at the beginning of a time frame, which is known as opening balance, from the cash balance at the end of the period. It could be a month, 3 months, or a year, or the closing balance. If the difference shows positive trades, it means more cash at the end of a given period. If the difference shows negative indications, it means that you have less amount of cash at the end of a given period when compared with the opening balance at the starting of a period. To analyze where the cash is coming from and going out, cash flow statements are prepared. It has 3 main categories: operating cash flow, which includes day-to-day transactions; investing cash flow, which includes transactions which are done for expansion purpose; and financing cash flow, which encompass transactions relating to the amount of dividend paid out to stockholders. However, the mark of cash flow is not an ideal metric to analyze a company when making an investment decision. A company's balance sheet as well as income statements should be studied carefully to come to a conclusion. Cash level may be increasing for a company because it might have sold some of its assets, but that doesn't imply the liquidity is improving. If the company has sold off some of its assets to pay off debt, then this is a minus sign and should be probed further for more clarifications. If not reinvesting cash, then this is also a negative sign, because in that situation, it is not using the opportunity to diversify or build business for expansion. Types of cash flow. There are various types of cash flow, so it's important to have a solid understanding of what each of them is. When someone refers to cash flow, they could mean any of the types which are listed below, so be sure to clarify which cash flow term is being used. The types of cash flow include: first, cash from operating activities. Cash that is generated by a company's base business activities does not include cash flow from investing. This is found on the company's statement of cash flows. The statement of cash flows, also referred to as cash flow statement, is one of the 3 key financial statements that report. Second, free cash flow to equity. This represents the cash that is available after reinvestment back into the business. Capital expenditures. Free cash flow to equity is the amount of cash a business produces that is available to be distributed to shareholders. It is calculated as cash from operations less capital expenditures. Third, free cash flow to the firm. This is a step that assumes a company has no leverage, that is debt. It is used in financial modeling and valuation. Free cash flow. Unlevered free cash flow is a theoretical cash flow figure for a business, assuming the company is completely debt-free with no interest expense. Fourth, net change in cash. The change in the amount of cash flow from one accounting period to the next. This is found at the bottom of the cash flow statement. Cash flow statement. A cash flow statement contains information on how much cash a company generated and used during a given period. Well, we should also know about the uses of cash flow. The most common cash metrics and utility of cash flow are as following: net present value, internal rate of return, liquidity, cash flow yield, cash flow per share, cash flow ratio, cash conversion ratio, capital expenditures, dividend payments, and funding gap. Well, this might have given you a fair idea as to what is a cash flow. And yes, don't forget to subscribe to the channel for future learnings. Thank you.